Today I have some interesting supply and demand strategies for you, and we're also going to cover liquidity and volume. So why is this a great supply zone? And there are a few rules when it comes to detecting and drawing the perfect supply and demand zone. First of all, the supply zone has to lead to a significant move. You can see here, this was the supply zone. I'm show you exactly why we draw it here in a moment. And afterwards, the market really sold off. So this is what we want to see. We want to see ideally a very strong trend, maybe even a turn of a trend. We want to see a short consolidation before the exit of the supply zone. So you can see the market had 2 candles of consolidation, or maybe even 3, a small bullish candle, and then here 2 neutral doji candles, and then this violent breakout, which is the point number 3. We need to have an initial move that has to be strong. And this strong move here is perfect. We want to find large candles where the price in just one straight line moves up or down in the case of a supply zone. And ideally we find supply zones early on in a trend. When I move this out of the way, you can see that the market has come from an uptrend, and then here, very close to the ultimate turning point at the top, the market is giving us this perfect supply zone. And how do we draw that, and how can we validate this is a great supply zone? For that, we are using volume profile on our charts. If you're using TradingView, what you do is you just go to the indicator, and then under technicals and then under profiles, what you turn on is the visible range volume profile. And then it gives you this. And what we see is that here is the supply zone, is that supply zones or demand zones are at the origin of a low volume drop. So when we look here right to the volume profile, you can see this is this really small volume peak. Well, no, it's not a peak, but it's a very small volume drop off after this large volume here. And you can see that at the core, at the origin of this volume drop, this is where you find your supply zone. And everything that we have been looking for in here, the 3 rules, is here also present. So we have the big drop, we have the small consolidation, it's early on in a trend, and it's a violent breakout. And we have this significant drop off in volume. And the lower the volume, the more significant the drop off is, the better it is for the supply zone. So this is a very important way of verifying and validating your supply and demand zones. We can go here even one time frame lower to the 1 hour, and here we can also see it. We have this huge volume cluster here at the top. Then we have this significant drop off. There's almost no trading interest and no trading activity going on here. And this is the key. Those are the best supply and demand areas. What we then do is very simple. We wait for the price to get back to the supply zone, and we want to wait until we see some type of reaction here. It could be a pin bar, it could be an engulfing candle. However, it's really important that you do not trade supply and demand zones blindly, which basically means a lot of traders will just put a limit sell order here at the supply zone and then automatically go into a short. This is not recommended, this is not good enough. What you want to do is on the higher time frame, you want to look for some type of candlestick pattern, just a way or a sign that the market is slowing down. And then we go to the lower time frame, and here we want to look for weaknesses in the trend. You can see when we look here, the market is still moving higher very strongly. Shorting a market like this is not a good idea. FOMO traders would short a market here, traders who fear that they are missing out, but we don't want to do that. We want to wait for clear signs that the market is actually finding here resistance, and there are signs that the trend is rolling over. What I love to use is the daily high-low indicator on TradingView. When you go to indicators on TradingView, you search for daily high-low, and then here, this is the one, daily high-low from unknown unicorn. Again, thank you a lot for making this great free indicator. And what it does, it just plots the previous day high and the previous day low on your price charts. And this is a perfect and a great indicator for the lower time frame. What we see here is that the price is still making fresh highs. The price was able to trade here above the previous day high, and this is a very bullish signal. We don't want to short a bullish market, very important. But now the picture changes slightly, and now we have signs that the momentum is losing strength. What do we see? The next day here we get the new daily high, the green channel, and the market is not able to reach the daily highs. So this is a failure to take out the highs. And then we have the first break into new lows. Whereas previously the market only made higher highs and higher lows, now we have a break into a new low. This is a very important sign that something is going on here. The momentum is changing here, as we can see. It is not enough to sell just yet. And if you have been a breakout trader, you've been going on, you've been maybe shorting markets like this in the past, this is obviously not a very good idea, and a lot of breakout traders are struggling with that. Why is that? Because stop runs are very, very common. After the breakout, where do the breakout traders have their stop loss? Just above this breakout area, right? The previous support area. And here is the so-called stop zone. The market is reaching for the stop zone. This is a liquidity pattern, a squeeze. And all the short traders that have been shorting the market here will now be in a lot of pain. They will be forced out in the market. So there's a lot of trading going on and a lot of hurt traders. So if you've been struggling with breakout trades and maybe you've seen this, what I would recommend is that you wait. You wait for the market to make a continuation. For now, we have only seen one lower low, but the real signal comes here later. Now the downtrending structure is confirmed. We make lower highs and we keep making lower lows. This is exactly what you want to see. You see the market breaking into a new low, and this is where the downtrend is confirmed. And you can see this is here the first signal. The market broke out, squeezed the stops again, broke out here and continued to the way down. So this is such an important market structure and such an important lesson on market structure that you should repeat this, you should rewatch this, you should print those out and look for those patterns. Higher time frame, supply zone, lower time frame, those breakouts, squeezes, and then the continuations. This is a classic way how the market moves across all the time frames. Here another very interesting example, and what we see here is on the higher time frame. We are coming from a downtrend, the market made a consolidation, and then the market is breaking into new lows, but is immediately rejected. This is what we would call a fake out. Other traders might call it a liquidity trap, but this is referred to as a fake out. And then the market shoots higher, it covers the wick. I made a video previously on what is eating the wick, also a very important concept. We have this strong shoot back above the previous support area, confirming the fake out, and then the market starts trending higher. Here's where we break into a new high. So in the downtrend, when the market suddenly starts to make a higher high, that is a very important shift signal, and here the market is rolling over. And then we can start looking for demand areas. Again, what we can do is consult our volume profile, and we want to look for volume drop-offs. We are here on the 1 hour, and you can see we have a high volume node followed by a significant volume drop-off. So this is a great supply or demand area in this case. Here I drew this zone as well. This is from the 4-hour time frame here, and now we are zooming in. And you can see, although there is a significant move here afterwards, there is no immediate volume drop-off after the market is leaving the zone. The volume drop-off comes a little bit later, so this is not ideal. The ideal demand area is here, where you have the consolidation, the breakout, and then you have this immediate volume drop-off. The trading activity is here almost not going to zero, but significantly reduced, which means that there's so much buying interest and there's no sellers on the other side. Nobody wants to sell here. And then what has the market to do? The market has to go up and to give you a higher price until new sellers are coming in, and the higher price is attracting more sellers. So okay, this is verified, this is a great demand area. Now what we do is we wait for a retest. In this case, the retest comes not instantly, but very, very quickly afterwards. The next corrective wave is already hitting this demand area. Sometimes, like in the first example that I've shown you, the retest on the supply or the supply zone, came a lot later here, after the trend was already here kind of over. In this case, the picture is very different, right? Because the market is still in this uptrending momentum phase and is then with a correction phase hitting the demand area. What we do is we go to the lower time frame, and here we want to analyze the short-term trend structure. What can we see here? We see that the market keeps making higher lows and higher highs, and it's very important that we wait for the market to clear a high. We need to wait for the market to make, in the case of a previous downtrend, a higher high. Only then we'll have this change of the trending mode. And you can see this is where it happens. Here we have the trend corrective wave, then we have the breakout above the swing high, then the market struggles a little bit with this high, eventually breaks it out, and then you can see the market trades higher. And you can see the demand area allows you to get into new trend moves pretty early, not at the absolute turning point. We don't want to get in at turning points. This is picking tops and bottoms. It's usually not a recommended approach, but we can get into new trades and new trends pretty early and then hopefully get a high reward to risk ratio. But also keep in mind this doesn't work 100% of the time, and nothing in trading will. Here another really interesting one. We are drawing here in a downtrend this supply zone. we are coming here from an uptrend. The market then has a small consolidation, broke out. The breakout move is very, very strong. You can see that here. And we want to analyze, is this a good supply and demand area? We do that by applying a volume profile, the visible range profile, and you can see here's the volume peak. And then here, this is where the volume significantly drops off. You can see this is a great confirmation that we are having here a supply area. Then we wait for the market to get back to the zone. You can see the market previously already almost hit the zone, but not quite. Then you need to be patient. The market comes back, gives you the doji. Also, what do we see here? When we zoom in, we see that this is a fake out. Other traders, again, might refer this to a liquidity grab, but I am old school. I call this a fake out. The market moves into the area, breaks the resistance, and then gives us strong selling momentum. This is not enough yet. This would be a really, really strong entry signal and a very aggressive entry signal. I would recommend to wait for the market to break into a new low structure. When the market breaks this low, you have a much higher chance that the market is actually rolling over. At that point, it still overall looks way more bullish, right? We even have this maybe inverse head and shoulder, right? The left shoulder, the head, the right shoulder. And I wouldn't be comfortable shorting the market while the market is breaking the neckline. Although there's this big supply area, it doesn't work 100%, and sometimes the market will just straight brush through those areas. So we want to wait for more bearish momentum. More bearish momentum is coming now. You can see the market is breaking here, the right shoulder. It is breaking the low, and also the way it breaks is very important. We have a high momentum breakout. That's great. And then you can see the market moves into the next low, have a little bit of a retracement. We don't violate previous highs, so the downtrend structure is still in play. We have some retests, some short-term fakeouts, and then the market continues, and this is how it currently looks. So really, really great trade study. This will help you understand turning points and will help you find turning points. But again, very important that you are that you're not aggressive, that you are more conservative. Don't just short because you're seeing a great supply and demand area. Really go to the lower time frame, wait for more confirmation that you see momentum is changing on the low-term trend structure, and then use your stop, use your target to find good reward to risk ratio opportunities. But accept that nothing works 100% of the time. This will fail also time and time again. So make sure that you understand how to take losses, and then the next winning trade might just be around the corner.